Chapter 6, Accounting Periods and Other Taxes. In this video, we'll be discussing LO65, Calculate Basic Alternative Minimum Tax, the AMT. The AMT originated back in the 1960s to ensure that wealthy taxpayers could not take advantage of special tax write-offs to avoid paying tax. It has evolved to impact many middle-income tax people because the numbers have not been indexed for inflation since the 1960s. So the amounts that are listed were considered wealthy taxpayers in the 1960s, whereas today it catches many more middle-income people than the law was originally written to catch. This is a separate but parallel system for calculating taxes. If the AMT tax, when you get done calculating it, is higher than your regular federal tax liability, you have to pay the higher AMT amount. And we'll go through how to calculate the AMT amount. The AMT rates are 26% of the first $191,100 plus an additional 28% on the amounts above that amount. Long-term and capital gains and qualified dividends are taxed at preferential rates. So this is a simplified model of the calculation for alternative minimum tax. You go through your tax return as usual and get to your adjusted gross income. From your adjusted gross income, you add and subtract what are called AMT adjustments and tax preferences, which we'll discuss in a moment. Once you do all those additions and subtractions, you come down to the alternative minimum taxable income. From your alternative minimum taxable income, you're allowed an exemption allowance, which is a given amount, which then gives you the amount of income that is subject to AMT. From there, you calculate it at the 26% rate or up to the 28% rate to get your tentative minimum tax. Compare subtract what you would calculate as your regular tax on income from the tentative alt-min tax. And if this is a positive number, then you have to pay the alt-min tax with your tax return. So what do I mean when I say adjustments and preferences? Adjustments are simply timing differences because they arise in differences in regular and AMT calculations. For example, depreciation. We don't discuss depreciation in this course, but since you've had 120, you're familiar with depreciation. Depreciation for regular purposes versus depreciation for AMT, the calculation is different. Calculation for depreciation is generally over a longer life for AMT, sometimes using a different method. So there's a timing difference. You would still have the same total amount of depreciation, but it's a timing difference. Whereas a preference is a general special provision for regular tax that is not allowed for AMT. So some common adjustments and preferences include state income tax refunds. They're not considered income for AMT where they are for regular income tax purposes. Net operating loss calculation, we learned about that in previous chapters. The way that the NOL is calculated for regular tax purposes is different than AMT. So that would be a preference that you have to calculate. Some passive gains and losses are different. Like I said, depreciation, exemptions, most itemized deductions, property tax, state income tax, and other taxes that are allowed as itemized deductions are not allowed for AMT. Excess depreciation or cost, if you have drilling costs, things like that. The whole list is there on page 614, but these are the things that you would add or subtract as AMT preferences and adjustments to get to your alternative minimum taxable income, your AMTI. The TCJA increased the AMT exemption allowance significantly. For married filing jointly, it is $109,400 now. The exemption is reduced by 25 cents for each dollar of alternative minimum taxable income, that AMT, over the phase-out amounts. That is on page 616. There's an example that walks you through how to calculate the AMT in its entirety.